something that I have been looking forward to for years is having somebody ask me hard questions about economics, about real estate, housing, all of that. This is something that I think the audience would love to see as well, because I would say it's fair to say that a lot of the people on my channel lean bullish. We have had Melody Wright on the channel several times. I would say she leans bearish at this point. But what we're going to do is we're going to turn this over to Melody Wright, and she is going to ask me questions because I trust her to have the audience's best interest in mind. And she's not just some doomer living in their mom's basement. She's really been in the business, has a tremendous amount of experience. And I think it'll be an interesting discussion. So, Melody, the floor is yours.
Sure. And Michael, I know everybody knows you, but would you mind just kind of giving your origin story or a little synopsis of your experience, how you got here? I think that would be a great way to start.
Awesome. So my real estate, just to give the origin story. So I believed in work 40 hours to 40 years to retirement. So I'm a Gen X. I was told, go to school, get a good job, climb the corporate ladder. So I did that. I went and got an economics degree. I started working, and then I went back and got an MBA in the evening. So I was working full time and getting my MBA in the evening. So very numbers oriented. I then got an accounting job, so I was very comfortable with numbers. That led to a consulting background in enterprise software, which led to a sales gig and all of that. Uh, I really started getting money in the .com era. I successfully turned 7 grand into 200 grand in the stock market. Ultimately, right around my 30th birthday, Melody, I lost most of it. I lost 80% of that. I went from feeling like a genius to feeling like a fool. Some people out there may have a similar experience in this era with crypto, for example. Again, when it runs hot. I remember saying to friends and family, I'm smarter than Warren Buffett. Those are always dangerous words. I did. I mean, I just have to own it. But then I lost 80%. And I ultimately went to cash with about $40,000 left. And I was depressed. 200 grand, Melody, was more than my family ever had. We grew up
Right.
extremely poor, house insecure. Money was a constant stressor. So losing all of that at 30, I had a wife, I had a family, I had a daughter. I was not in a good headspace. I believe that the stock market was a casino, and I didn't have the inside track. I didn't have the rules. I didn't go to the right university. So in a depressed state, because now I'm 30, I'm traveling 3 days a week for work on airplanes, which I hate. The only way I can get through that travel is to read books. I can focus, and my fear of flying goes away. It's a saving grace. Did about 1,000,000 miles flying, and I hated every mile. I found Rich Dad Poor Dad. It changed my life. I was 30 years old, made 6 figures a year, have an MBA, an economics degree, and was an accountant for 2 years. And that book introduced all kinds of new concepts to me.
Mhm.
So for a year, I consumed books. I read several hundred. They told me to invest in my backyard. I happen to live in the Silicon Valley. It has never made sense in my lifetime to invest here, but I did not know that. So for 52 Sundays, I tried to find cash flow in the Bay Area. It didn't work. My wife, much smarter than I am, sat me down at week 52 and said, I'm not doing this again. Figure something out. So at that point, I wasn't willing to go back to the stock market. I wasn't willing to go out of state because I hate flying that much. So we pulled out a California map and we drew circles. And 2.5 hours away, there's Fresno, California. Never lived there, never knew anyone. I drove through once as a teenager going to Yosemite, nothing. But the numbers made sense.
Mhm.
So we start looking at Fresno, and ultimately we find 1818 Norris Drive East, 93703, 4 bedroom, 2 bath, 2 car garage, single story in my buy box. And we buy it. 107 grand, rents for 1,200. Cash flows day one. I didn't know any 20% down, normal loan. You could look it up on Zillow. I gave you the address. We closed December something 2002. And we're a landlord. And I'm excited. I'm happy. But as stories go, real estate tests you. My first tenant who moved in never paid rent again. We did everything right.
Wow.
Credit check, reference check, income check, landlord reference, everything right. They just got divorced. And the wife took off. The husband became an alcoholic. I, again, invest in California. So it took 3 months to get him out, and he damaged the property. I walk into that property. We've owned it now 4 months. Maybe it was 4.5 months. Defeated again. Remember my story. I just lost 80%. I'm wrecked. Like I let my family down and I just burned half our cash. My wife, Olivia, thankfully, smarter than I, said, did we do anything wrong? The answer was no. We did everything right. There's just no box for, are you going to get divorced on the rental application?
Right.
And she says, let's try one more time. Because again, we don't know Fresno. By that point, we don't have rent for 3 months. We're paying $1,000 in a lawyer to get them out. And so I'm reading all kinds of horror stories. Fresno's the armpit of California. Crime is everywhere. Gangs. I'm just circling the drain. Olivia says, no, let's try again. Thankfully, we do. And the rest is history. The next tenant moves in, never misses rent, cash flows. I go do a cash out refi, which is really easy to do in 2005. I pull all of my capital out and more, unfortunately. So I turn Norris Drive into what I call an alligator, which means my mortgage payment is higher than rent. Never do that, folks. That's dumb, 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 dumb. But thankfully, we take that 40 grand and buy 2 more units. So we start to ladder up. This story gets really interesting in 2006. You remember that time. Everybody was hot. Fresno, California, you can go look it up, is the highest appreciating market 2 years in a row. Bonkers.
Oh.
Nobody thinks anything can go wrong. Housing only goes up. I remember people saying this stuff. And I go to a Bruce Norris event who says California crash is coming. He talks about something called the Affordability Index, which I had never heard of. I look it up. Fresno's Affordability Index is lowest it's ever been. It's a 13, where historically it's been a 40, which means only 1 in 10 could buy a home, where before 4 in 10 could, simply said. So I take action. I sell every single house, which ultimately is at the peak. We do not sell them and take the cash. We sell them and do what's called a 1031 exchange. So we sell 8 homes, 1031 into 80 apartments right at the peak. We got lucky, but we took action. Then the crash happens. My 80 apartments get better tenants. Rents are going up. We're safe. We have no homes at this point. Then the crash, my market fell 75%. 75. My house that I sold for, you can look it up on Zillow, sold for 286. It was retraded 4 years later at 75 grand.
Wow.
So I'm glad
Wow.
so I took action, right? I saw it coming. Then we start buying houses for nothing, but there's no lending. You know this, right? You used to be able to get seemingly unlimited loans. Then it was 10, then it was 4. No banks would talk to us. We're buying properties for less than land value. Nobody lends to us. So we start telling our story. We start borrowing private money. I start paying 12% interest. And we do what today is called a BRRRR, right? Purchase price, somebody buys it. We fund the repairs. We buy a bunch of houses. And then obviously it bottoms in our market in 2010, 11, and it slowly comes back as Wall Street floods the market. I was there. I remember the process. On Monday morning, we would get a tape. What was a tape? A tape was a load of the latest REOs. And on Monday, I would go through the tape for Fresno. I would find the 5 or 6 that I would write offers on. I'd write 6 offers. I'd get 3 counters. I'd close 2 deals. But one Monday, Melody, nothing showed up. I'm like, data corruption, weekend. Next Monday, nothing shows up. At this point, I have a name. I use it to call a president of some title companies. And they basically say, somebody from New York, their words, somebody from New York bought the entire tape.
Yeah.
I didn't know you could do that. I didn't know that was a thing. But the problem was, Melody, they were buying them at list price for 2 years. My process was 18% of list price, because that's where they said yes. They wouldn't say yes at 20. They would say yes at 18. I did that for like 18 months or 2 years. But now Wall Street came in and mucked it all up. And they were just buying the entire tapes. And then, prices returned. So ultimately that continues. So at this point, we're in the game 10, 11 years. I'm looking at my market every day. I never change my market. I think that's important. A lot of people want to be in 17 different places. You don't get skill. You don't get experience. You don't really learn anything by being that risk averse. So yeah, ultimately my wife retires probably, God, what year is it? 24 now. She retired 8 or 9 years ago. I retired 5 years ago, just on cash flow. We don't have any partners. We don't have any JVs. When we say we owned nearly 200 units, we do. It's us. I will say, to wrap this up, I thought we were going to have some pain in 2019. So something I did, and again, they can go back on my channel, is I sold 2 of my apartment buildings because I saw cap rates getting compressed. So again, I take action when I
Yeah.
see usual behavior because I'm focused. Um, Little did I know, Melody, I lost $1 million. I sold early.
Wow.
Cap rates
Yeah.
compressed even further because of this silly pandemic. I sold it like a 6.5, 6.7. In my market, they came down sub 5. That's never happened before. So I
Wow.
expect lots of pain in the years to come. I'm set up to 1031 out of houses into apartments. That's my playbook for the next 2.5 years. But yeah, we're just a couple that did one rental at a time, looked every day for 20 years. We took action. We're not just buy and hold forever, right? We moved money. We did 1031s, So I don't just talk the game, right? We're making moves in our portfolio all the time. So that's kind of the full story, I guess. Ask any question you'd like.
I think that's great. And so I think kind of what we did, in our interview, Michael, why don't you just kind of give me your picture of what happened last year and just kind of overall, like what you thought was going to happen, what happened, and then we'll kind of talk about what we see in the next year and we'll get then to some
Yeah.
specific questions.
So I believe I did a forecast call on January 2nd of 2023. Couple of things I got wrong. I thought interest rates would be in the sixes. Now they ended up in the sixes, but they've been on a wild ride. I did not see 8% mortgage rates. So I got that wrong. I saw a flat housing market. My general belief of the United States housing market when using the median price is we got a decade of appreciation in 2 years. So we have 8 years,
Mhm.
roughly speaking, a flat market. Could your market be different? Yes. But the national numbers simply said we got a decade of appreciation in 2 years. So I'm calling a flat market for 3 or 4 years. I would argue I got that right.
Mhm.
The thing that I really
Mhm.
got right was a transaction crash. In fact, I
Mm.
called the number. I called 3.8 early, and we got a low of 3.79 in October. A lot of people didn't understand that we have been here before. What do I mean by that? A lot of people on YouTube, and especially the folks that I call crash bros, again, not you, but the folks that never owned anything, never did anything, um, they always want to relate it to the Great Recession. I am not comfortable doing that. So something I did way back in 2021 is I built what I call a 50-year spreadsheet. I went all the way back to 1970 and I collected all of these economic metrics. Um, and one of them was median price and income and rate and stock market and all kinds of anything that I could get a trusted resource all the way back to 1970. And oh, by the way, I give it away on my website. I think it's that valuable for free. Just go get it. It's all yours. But what that taught me, Melody, is we have been here before. What do I mean by that? We have seen the Fed raise interest rates 500 basis points before. Now, it's fair to say we never did this fast. We weren't on this low basis, but we have raised rates 500 basis points before. That's intriguing to me. So, what I did way
Mhm.
back in 21 was what happened? Well, it's probably not shocking when you raise rates by 500 basis points, it becomes less affordable. And oh, by the way,
Right.
it's probably not shocking to hear now in hindsight, transactions crash, which
Mhm.
is why I called it. And oh, by the way, what really shocks people and blows people's minds is prices don't. So
Mhm.
that's what happened from 1978 to 1981. And again, we've been here before. It is horribly unaffordable today, but it is not the worst ever. The other thing that
Mhm.
I have shown, again, just based on history, is what a lot of people are getting wrong, including NAR, including Zillow, including all these freaking housing sites, is they're expecting some whiplash return of transactions. Guess what, folks? In 1978, we did something like, I don't know, 5 million. And I actually have the spreadsheet. We can go look at it if you want. We did something like 5 million transactions. It took 14 years to get back to 5 million transactions. Now, do I think it'll take 14 years this time? No, stuff happens faster, but it ain't going to take 14 months, right? It'll probably be 4 or 5 years for us to get back to an existing home sales north of 5.5 million. I think, I think people are too optimistic about transactions, but this is important, right? Because the United States GDP, housing related, is about 13 or 14%. From an economics
Mhm.
perspective, housing has been a drag on GDP for almost 2 years now. It does appear to be bottoming. Yes. Will it be net positive going forward? Probably, but not by these massive numbers that people are talking about. So that was my call. Transaction crashes, prices flat. I got their interest rate wrong. I did not see 8%. So that's generally my 23 call.
So, let's stop here and talk about kind of that comparison back to, the late 70s, early 80s.
Mhm,
And from a productivity perspective and kind of wage increase,
mhm,
I think a lot of people argue we don't have that kind of momentum going into this cycle. So,
mhm.
especially, where we are today, a lot of people argue that we actually have never recovered from the GFC in terms of full employment. You can just see there's like 2 million men missing from the workforce that have never come back. And so, we were going up in terms of our GDP, and it's
Yep.
just, it does not look the same since the GFC. So, in your opinion, I
Mhm,
think, we saw in 21 that wages, we all thought we were about to get rich, wages were, it seemed like finally,
mhm,
wages after just kind of being stagnant for so long
mhm,
were going to increase. But what we've now seen is that's all petering out. There might be some
mhm.
very small wins, for the pilots last year,
Right.
et cetera. But, with the AI headwinds, from
Mhm,
your perspective, what do you think? Because when we look at kind of that affordability index
mhm.
right now,
Yep.
what do you think is going to change to actually get us back on our feet so that people
Yeah.
could afford the prices that are out there now?
Yeah, affordability is the right metric. I think a lot of folks talk income and price, but then they obviously miss interest rates or lending. So I'm glad we're talking about affordability because it is all affordable. Again, I want to be clear. The affordability metric is what caused me to sell my homes in 2006. I sold them all. I'm like, I'm out of here. I'm done. But why am I not selling today is kind of the question. And that is because A, I don't see a great opportunity elsewhere for the equity. But B, again, to my earlier point, I think we're going to have a decade of flat prices. This is not going to be a quick return to where we've been. I wish I could tell you different. It's going to suck for a while. But I think there are three metrics that get involved, and wages is the important one. And in fairness, wages we have to talk about in two lenses: nominal and real. Nominal wages in 2020 and 2021 were fun to talk about. But in reality, you were losing. You were going
Mhm.
backwards, right? In
Right,
a real adjusted manner, they were negative. That's not good. What I
right.
believe has transpired over the last 6 or 8 months is we have finally gotten real wage growth, right? Let's just genericize inflation is 3, wages are 4.2. That is at least the right direction. I believe we will have wage growth on a real basis for the next 5 to 6 years. It'll be 1, 2, maybe 2.2. Nothing. I'm not talking 4, I'm not talking 5, but I am talking 2% compounded for 6 or 7 years. That on top of flat prices and lower rates slowly
What do you think?
grinds the gears to affordability.
Yeah, so what do you think is gonna drive that wage growth? And then if you could also
Mhm.
address kind of the headwind of AI, I think
Yeah. That's
that would be critical. Okay.
so I think a lot of it is going to be what is it? What ages, right? There's a lot of population headwinds, right? The baby boomers are retiring, and we still have a growing need for a workforce. I mean, you can look at the JOLTS report that came out today, 8.6 million openings. So there's plenty of jobs out there. Now, a lot of those are low income and all of that. But um, I do think there's a generational trend towards uh, more value add activities. Now, again, is everybody going to make six figures? No, of course not. But I think there's a general want from the system of more labor than exists. So as long as you're willing to invest to skill up, it should be easier, right? One of the things to get wage growth is job changing, right? Go from employer A to employer B. So I think people need to take advantage and manage their own resume and really take skills and learn and go that way. I say this as somebody who did that several times in his career. And when you get good at something, somebody else will pay you more for that. And that's a way that you could do this. We're not going to be the baby boomer with 40 years to get the gold watch. Don't do that. That's your current employer doesn't value you. So own your
Yeah.
stuff, invest in yourself, and then go earn more money elsewhere. I think the people that did that would benefit. Now let's talk about AI. So I am somebody
Can I
who
stop
is
you for just a second
sure,
there, if you don't
please,
mind?
please. No, of
So let's
course.
stop there
Your
because
show.
you just gave a great Gen X response. And I'm Gen X, and I'm just like you, Michael. I grew up very poor. I've hustled my whole life. I was working two jobs in high school and, on the dance team, so
Wow.
like, oh yeah. So I totally get it. But you and I have a very different perspective. I've been
Sure.
managing people since for over 20 years. And I noticed a real shift in the workforce in terms of, kind of the expectation of what is work, how many hours should I put in, how much
Mm,
effort should I put in. And so, going back to what I said previously, that we see 2 million men
mhm,
missing from the workforce, like, and so if we look at pure demographics, yeah,
sure.
theoretically, but how can, what is going to change to bring everybody back into the workforce to participate in a productive way? Because as
Mm,
you said as well, a lot of those JOLTS jobs, and this is something I see all the time, are
yeah.
low income jobs. They're service oriented because what a lot of people have done instead of saving for a down payment is
Mhm,
they've gotten upset, sad, they can't buy, and they're out there, paying for experiences out there, going to Starbucks twice a day. So how are we going to change this? Like, how are we going to bring people into the workforce to be able to be productive enough to be able to afford a home?
So I think there's a couple of things. This is a fun conversation. One of the things I think is fair to admit is economists don't change or evolve very easily, right? They're stuck in their models. They're very much backward looking. I don't think it's unreasonable to say and admit that the pandemic broke lots of models. Some in a bad way, some in a good way. I believe, and again, it's just a belief. I could be wrong. I'm wrong all the time. But I believe what we have
We
seen
all
is
are.
yeah, it happens all the time. A structural change has happened to our economy. I believe these 2 million men are working, are productive, but aren't counted because the historical models don't pick them up. Now, what could that mean? Could mean driving for Uber and, Lyft or DoorDash. It could mean having a YouTube channel and creating content and you're monetized. There are there are more ways today to earn income than our economic models catch. So my underlying belief is the general economics from the experts is broken and they're too arrogant to admit it. I think for the most part, those 2 million men in this example are producing income some way, somehow. Because if you're not, you're living off mom and dad or your girlfriend or boyfriend or whatever, that's not going to last long. We live in a society that takes money to live in. So it is just my fundamental belief that they are working somehow. They're producing income. Now, if you want to call it work, that's up to you, but they're producing income somehow, some way. It's just not caught in the model. That's when I read those things, that's what I think. I'll stop there.
Isn't the birth death supposed to catch those, because theoretically, if they're on their income tax or they have to have, if they're working for themselves, from a tax perspective, but what are your thoughts on that?
Well, I think there's so many different ways with PayPal and, Zells and all these other things to make it a cash business or semi-cash business. It would not shock me if would-be taxpayers are finding ways not to file taxes. It would not
Yeah.
shock me. At the end of the day, my belief, studying the economy, I've been studying the consumer for 30 years. You can't exist long term in this economy without money coming from somewhere. Now, maybe it's illegal activity. I'm sure some of that is, but I don't think, I think the lion's share of the missing is our models. I mean, you know this. Our models are, let me call an employer and ask how many people are working. If I'm a YouTuber or, a TikToker or whatever these other, you're not getting counted, but you're certainly producing income. So that's kind of my belief.
Yeah, I think I would give, kind of an alternative, just
Sure.
perspective, just, people that I know, and
Mhm.
I'm a big like you, I study the consumer, I listen to everything everybody says, like I'm always thinking, thinking, thinking. And I can tell you that I know several families of people that have graduated 18, 19 years old and they're not doing YouTube, they're not driving for Uber, they haven't even gotten a driver's license. And so,
Yeah.
and I think we're seeing a lot of these trends, right? That people aren't getting their driver's license, they're
Yeah.
not
True.
independent. And so I think that, it's probably I do agree with you. There's probably non-traditional, means to income, but I also think that there are actually a lot of people that just aren't working and they're and
Mm,
I don't want to I hate stereotypes, but but they are actually literally just playing video games all day. And
mm,
there is a possibility too cuz some of these pay for play like in the Philippines they have a huge unemployment rate there and a lot of
yep.
people actually play games and make money through playing games like
Mm,
you're actually and
wow.
so there is this, like, you take a real job in the video game of, like, picking up garbage and you get
Mm,
actual money, and this is in
interesting.
Asia, it happens in other video games too, and this is something I actually thought might be kind of a future of work
Mm,
type of thing,
could be.
that
Yeah.
people are because they're playing those video games. So, I do think it's a very interesting conversation because I think that is the key is figuring out what's going on with these people that aren't in the traditional workforce.
Agreed.
But doing that non-traditional work, and if we look at something like Uber, and maybe this is when we need to kind of talk about your outlook for next year, because
Mm,
I think if the economy does start to soften, a lot of those gig workers, and they're struggling already. I mean, we hear it already from them.
I agree.
How are they going to over the next several years? How are they going to be able to make enough money to be able to buy a home, be able to even pay rent and move out of their
Yeah.
mom's basement?
This is awesome. I love this conversation. Thank you for being here. Thank you for doing this. Thank you for saying yes.
Sure. Thank you.
So we'll do my 24 kind of outlook, and then we'll talk about kind of what happens if I'm right. So I'm calling a recession. Again, something I got wrong in Q23 is I thought we'd have a recession. I actually am getting really ballsy. I'm calling Q1 and Q2 recession. So kind of short and shallow, but a recession nonetheless. I would think unemployment probably gets above 4 or 5, but below 5. That's kind of my window for unemployment. Um, One thing to know about 5% is for the longest time that was considered full employment. When I got my degree, Melody, was 6% was full employment. Now it's 5. So it will be up and up noticeably. That'll be millions of people, unfortunately, laid off. That'll be a problem.
Mhm.
So recession, unemployment. I do think mortgage rates get to I'm going to call it 6%. I do not want to see 5% mortgage rates. I don't want a market like this. I'm done with that. Let's just slow and steady. Let's just freaking get to
Right.
the other side of this. We broke housing and we got to pay the price. Um, so that's generally my call. It's going to be a messy year. We got to realize it's an election year. At the end of the year, that's going to create all kinds of stuff in the second half. I do think the Fed cuts rates. My hope is it's somewhere between 3 and 4. It's not 6. It's not 9. Because I think if we
Mhm.
get 6 or 9 rate cuts, Melody, something broke. Like broke. That's like we get 6 rate cuts.
Definitely.
That like be careful what you wish for, people. That's ugly. I
Right.
think we get three or
Right.
four. Yeah, it's a recession, but not terrible. So there's that. Now let's get to the other side of this. What is that person to do that's been I'll call it a gig worker just to genericize it for a minute. And you're absolutely right. I know a lot of people like this. In fact, my daughter doesn't have a driver's license. So she's a millennial. But I've lived through this. Like, you don't get your driver's license at 16? Are you kidding me? What are you doing? That's
Right.
like a rite of passage. She didn't get it till she was
Right.
like 25 or something. Um, so I unfortunately think that people that relied on gig work are going to suffer. And at some point, reality is going to hit them and they're going to have to go get that damn job.
Mm.
At some
Hmm.
point, it will be better to work for Chipotle than deliver Chipotle.
Right.
And the last 2 years have been fake. The government sent money to everybody. The government said, don't pay your rent. The government said, ask for forbearance. A lot of people got soft and they got used to it.
Hmm.
And oh, by the
Right.
way, we got used to a job market that had 10, 9, 8 million openings. So if you sucked at your job, you could get another one.
Right.
We're going to get to the point, unfortunately, where you got to work, live with family, or other bad options. I think that is what's coming. And unfortunately, as my opening session taught, I had to get kicked in the nuts before I figured
Hmm.
out. I lived paycheck to paycheck, just like everybody else, until I got kicked in the nuts and lost all that money. And unfortunately, we've been living in a fake economy, and people have been watching other people live and flex in a fake economy. And the other side of a fake economy is pain. Pain's a great
Hmm.
teacher, but it still sucks. You and I are
Hmm.
Gen X. We've seen a lot of pain. .com
Yeah. Oh,
crash,
yeah.
9/11, all the, so we're like, dude, give me another scar. I'm good to go. But, folks
You're
that
right.
haven't seen it, like, dude, a recession is a natural part of the economic cycle. Our Federal
Right.
Reserve is trying to pretend like they don't exist. And they've been right
Right.
for like 13 years, except for that little micro one in March of 2020. People
Right.
don't get it. Recessions are good. They clean out misallocation of capital. They take these zombie companies and shoot them in the head. And then we can start growing it. But recessions suck. They're painful, especially your first recession. I remember my first
Right.
recession. I lost it all, seemingly lost it all. I'm
Wow.
now diversified and all of that. But yeah, if you're a Gen Z or a millennial and this is going to be your first one, really Gen Z, I guess millennials saw the Great Recession, but they probably weren't working, right? They were probably, you know, it's recessions suck. They're unfortunate. But on the other side of that, some people will, go get, that's what I think is coming.
Wow. Yeah, and so what do you think so, kind of talking about a couple of things you mentioned. Well, I wanna park demographics, but I wanna go there
Mhm.
some more. But, with all this multifamily coming online,
Mhm.
with the themes of what you're just talking about of, hey, you're gonna if you did, the government sent you a check, you did all this gig work, you thought you were richer than you were, you went out and got an apartment of your own, and suddenly the gig work's gone
Mhm.
and you realize, oh boy, I gotta move back in with mom or dad or whatever.
Mhm. Yeah.
So what do you think that's going to do or the impact that it could potentially have on like home prices, for instance, if
Mhm.
because we know, right, in most cities across the country right now, it's cheaper to rent than it
Oh
is
yeah.
to,
No question.
to buy. And so, but at the same time, you've got this flood of build to rent, you've got this flood of multifamily, you've got this
Mhm.
flood of new builds, like everybody's competing for the same customer. So you think that prices will just kind of chop, chop, chop for the next like 2 to 3 years and not see any meaningful decline. Is that correct?
Well, let's break it apart because I have very different opinions about different chunks. And again, I play in both spaces. So let's talk multifamily first and let's define that. That
Sure.
is commercial real estate. Let's call it 50 units and above. There is a clear set of pain coming to that market, both from too much delivery coming, right? Builders are very simple. You and I have seen this, some people for the first time. Builders will build until they lose money.
Yep.
They're about to lose some
Yep.
money. It's just
Yep.
how it goes, right? Developers develop until they get their butt handed to them. Then they come out the other. We're going to go through that. There's a lot of money, a lot of pain coming to multifamily apartments, both operators and creators and operators. That's an important word, right? If you bought a building, and I have some, you are likely going to see, if you're in Class A stuff, you're going to see a lot more competition. You're going to see move-in specials. You're going to see rising rent problems or rising evictions. There's a lot of pain coming to multifamily. So yes, both rents are going to go down, move-in specials up. There are going to be a lot of people that lose their buildings to foreclosure. That's that. Now let's talk about single family. Single family is different, in my opinion, from a value perspective, because we have something in the United States that is pretty unique, and that's the 30-year mortgage.
Mhm.
A lot of transactions were purchased, but even more were refinanced at the depths of the interest rates. And the reality is, a lot of people, whether we like it or not, can afford the mortgage payment on unemployment insurance. It is that low. Second, if you're in a home, you don't usually want to go from a home back to an apartment or back to your in-laws. So you will find roommates. You will do something to stay there. This is why I think transactions don't spike and people just scrimp and save, and it just, it's just flat for years to come. There will be some people, death, divorce, job transfers, but that's why we do 4 million homes. We're not going to do 5.5. I don't see this wave of supply coming from, hey, I'm going to sell my home and go move into it with my mom and dad. That's very different than an apartment, in my opinion. Um, so again, I think a recession hurts. I think recessions are going to cause people to make tough choices. I think the people in homes that have a 2 handle, a 3 handle, in many cases, if they sold their house, they would go rent and it would be more than the mortgage. That's not an economic decision, rational decision. I think most people make. Some will, absolutely, but I don't think most will. I could be wrong. But I would definitely watch weekly new listings to see if I'm wrong, because
Mhm.
weekly new listings is the metric that we get once a week that will tell us if we have a problem. And if new listings keep trending where there are, it's not a problem. But that's where I watch every week, every Friday, what's going on with new listings. Because I admit I could be wrong. Maybe everybody will sell, but we'll see.
Yeah, and I think one thing that a lot of people aren't considering, I'd like to get your thoughts on, and this is something I kind of wrote in my Substack this week, is, I spent a lot of time last year trying to reconcile the listings that I did see
Mhm.
versus what I was seeing in front of my eyes, right? As I went out on the road to all of these different cities. And
Mhm.
also based on what I was seeing with permits, things just
Yep.
weren't making sense. And, that's when I started diving into the MLS,
Mhm.
over 600 of them in this country, who's
Mhm.
aggregating them, who's not. Are
Yep.
they using broker sites? Are they using building sites?
Yep.
And that brought me to an article that Inman did in September about pocket listings. And,
Mhm.
everyone in the industry will tell you it's not a thing, except it
It's
was
a thing.
such a thing
It
that
is.
NAR went crazy in 2015, did presentations like, and these stories I would hear, like custom builds for
Mhm.
Airbnb, for instance, that would get sold on Facebook.
Mhm.
And then on top of it, you have the private note sales that
Mhm.
nobody's tracking. And these are
Yeah.
kind of those
Yeah.
all in the family. Well, I say all in the family because they do transact among themselves, but didn't initially start that way. It starts with them going, they see somebody that's a little bit delinquent,
Mhm.
they reach out to them
Mhm.
and they say, "Hey, we want to help you out with your loan. We'll
Mhm.
pay your mortgage. We'll maybe
Right.
give you $5,000. And once we find an investor, we're going to buy that property from you, pay off the
Mm.
mortgage, etc." All kinds of these sub two. I'm sure you've heard
Yeah.
of it.
Oh, I've heard of
But
it. Yes, yes,
yeah,
yes.
and so, I think that that's the other thing to your point about economists not realizing things have changed. I think that in the real estate industry, people have not understood that the people have started transacting in different ways, and it's
Amen.
it's
Yes.
kind of not showing up in those traditional metrics like the listings, for instance. And one thing that I've recently noticed is that the builders seem to be pulling their listings at the end of the year. It's not that they didn't go away. They're trying to work with,
Yeah.
or, certain people. And,
Mhm.
we know that the Fed uses realtor.com. That's their source for inventory.
Sure.
But what I've noticed, I did a big scrape of the builders and I looked at, where those properties were listed. They weren't on
Mhm.
Realtor, they were on Zillow. And I
Mm.
think, and that was new. Like they
Yeah,
usually list them on all. So
you're
I
right.
think there's like some tricks out there. There's some
Mhm.
things that people, but I like you, that's why I track weekly listings. I think we're gonna
Yep,
see that, and we've already
good.
seen it. But I think that there is probably inventory out there. Right now, if you don't you there's 11 months of non-annualized of new builds,
Mhm.
inventory out there. It's a
Yeah,
lot of in
yeah, so first off, there's so much you said there that I agree 100% with, but let's break them down in pieces.
Yep,
So let's talk pocket listings first, because that's actually a term that people can look up. So if you are a seller, like you own your home and you sign a listing agreement, it is my understanding that agents have 72 hours, aka 3 days, not business days, 3 days, to post that in the MLS. In theory, even today, that could be considered a pocket listing for 3 days. I'm going to call my best friends, my other clients, blah, 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 blah. So that does occur. But once you hit 72 hours, it is my understanding that is then becomes a finable offense. So that's realtors, in my opinion. It used to be a bigger problem. It used to be weeks. Now I believe it's 3 days. Now let's talk about builders.
well,
And
when's that they
as
can do
oh,
the
sh- yeah, go
sorry,
ahead.
the
No,
coming
please.
soon, you can do for 21 days,
Oh,
just
there you
so
go.
you know, like,
Right.
so the
Yeah.
coming soon, you list it, but you don't
It's a
have
different
you're
flag. It's not
marketing
active.
behind the back.
Yes.
Exactly, and so that was creating a lot of FOMO because when people
Mhm.
would when it finally came live, people would call up and say, "Hey," and they're like, "No, it's already gone." But
Yeah.
it
Yeah.
happened, they
You're
were
right.
marketing it for 21 days, but sorry to interrupt, keep going.
No, that's perfect. But again, in fairness, it's in the MLS at that point. But that's a
Right.
yeah. But now let's talk about builders are very interesting. And again, I only can say this because I was watching builders in 2006. Like I bought from a builder, right? Right. I bought a model home from a builder and they did a lease back. So I've been doing builder stuff for a long time. When the market is hot, they put one listing in the MLS, right? The model home and nothing else. Back in
Right.
'06, that was a problem because they were building 20 homes at the same time and nobody bought them. Today, for the most part, there are exceptions. They're not really building until there is a contract, right? Which is a very different strategy than before. That
Well,
said,
they've all shifted to spec now. I mean, they're
yeah,
all like this has been a huge shift and
yes.
they're not built they're so most of them probably in the middle of summer shifted to spec.
Mhm.
So, according to Zellman anyway, but go
Yeah.
ahead.
That said, there are still opportunities to get a great deal from a builder. I say this as somebody who bought a home in 2023. I found a builder who had somebody back out. It was already built, already done, everything except the backyard. I went to them. I negotiated 12% off purchase price. I got all the upgrades for free. I got them to buy down the
Brilliant.
mortgage rate to 4.99, 30-year fixed. I got 10 grand at closing. I beat that builder up every which way from Sunday.
I love it.
Yeah, absolutely. But to your point, it wasn't listed. It was nowhere.
Mhm.
I found
Right,
it because I knew what I was looking for and I knew how to ask
right,
questions of the builder
right,
because they had a model down the road, right?
right,
And they were trying to sell me some
right,
other home for 400 grand more. But I'm
right.
like, tell me about that one. And they're like, oh. So
Yeah.
there are lots of stuff that builders won't list. That said, when it gets slow, builders do throw more inventory on. I'm seeing today, again, in the two markets that I look at every day, there are more new builds in the MLS than there was 18 months ago. So that's some of the artificial rise in active listing is because builders finally are putting listings. In 2021, a builder never had to list a new home. They listed one, which is the model, and they sold from there. Today, as properties are getting closer to done, they're listing them. That's just the market being slower. So some of the active listings increase is simply builders listing more homes, not mom and dad selling more homes. That's what I'm seeing in my two markets.
That's fascinating because, in the 75 markets that I track, I'm seeing the builders pull them off of realtor.com. And,
Are they putting them on Zillow? Are they just gaming the
they're putting
system
them on
because
Zillow. They're putting them on
dirty
Zillow.
tricks, dirty,
Yeah,
dirty
and
tricks?
and I mean, of course, not all of them, but
No, of
please,
course.
they never do that. You can go like, I mean, I have several case studies where I go in, there's like 300 homes and there's
Uh,
one on,
I just had this crazy thought tying together all this nonsense with NAR. I wonder just a I wonder if it's A, cheaper to put it on Zillow, which I'm guessing it might be. I'm just wild ass guess. I have no idea. I'm sure you could find out. But two, maybe it's a way for these companies to give the middle finger to realtor. Maybe there's some kind of
I
backroom chatter. I don't know. I That seems really weird to me.
I don't either. I told someone a realtor I know, "Please go ask somebody,"
Yeah, ask
because
somebody. Yeah,
it's fascinating, and the fact that we all know the Fed uses realtor, but not, and
exactly.
so that is what I, because to me, understanding what I've seen out there in terms of, supply, it's
Mhm.
just mind-boggling. I would be, blasting everybody trying to sell these
Exactly.
things, and they're doing that in email. They're doing it, so, and they're, but to your point, they may be in the MLS that you're seeing, but not syndicating to realtor. Why wouldn't you syndicate to realtor? Like,
Yeah,
that's
yeah. I mean,
fascinating to me.
cost, maybe some data manipulation. There's got to be a
I don't
story
know.
there. There's
I
like if
I
you're putting
wanna
them on
know what it
Zillow and
is.
not yeah, I don't know. I don't know.
Well, that's why I don't know if you've ever heard of Parcel Labs, but one of the things that they just simply do is there's a kinda new entrant
Parcel
to,
Labs.
yeah, looking at listings, for sale. They're kinda in the
Okay.
micro trading home price game, but
Okay.
the first thing they did, from, Silicon Valley,
Mhm.
but the first thing they did was just do address resolution, like, they would take,
Oh, yeah, yeah.
all 3 sites and kind of compare
Mhm.
and then, resolve the address, and then they were coming out with, say there was 9,000 on Realtor, they would come with 11,000, and I was just like, "This can't be true, really? Somebody's just selectively, listing on
That's
Zillow and
interesting.
not Realtor?" Yeah, so it's been very fascinating to kinda watch this, and then, you
Hmm.
know and again, those are the ones that are listed because I think there are private transactions happening that never make
Oh,
it to
let's
the
talk about that.
MLS.
Let's talk about that.
Yeah,
So again, one of the things that really picked up in 2020 and accelerated through 22, and then we'll talk about sub two next because it's now sub two's time in the sun. From 2020 to 2022, there were these things called wholesalers, right? That just took off. Everybody was a wholesaler. They were finding a dump. They were getting a contract. They were assigning it. They were making a bunch of money. Those properties never went into an MLS, never saw the light of day. They did go through title, escrow, or legal because you want a clean title.
right,
So again, if
right,
your data source is Realtor or Zillow or Redfin, you've missed all of those. And I say this as someone who probably bought a dozen wholesale deals, never saw the light of day. Didn't know it was a sale, wasn't counted as a transaction, but it did happen. Now let's talk about sub two. Sub two is something we have to watch. Sub two is not something I'm comfortable with. Just myself. I know
no.
there's Pace Morby. I know there's lots of people that I get it. I get it. I get it. I'm old. I'm a boomer. Blah 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 blah. I got it. It's not my thing.
Well, let's see.
Yeah,
Let's
let's
reserve
see.
judgment, Michael,
But
for a
I just
few
don't want
years.
all the freaking hate comments, and I don't need that headache. I already get
I
enough
hear
hate.
you. They can
But
hate me, okay.
it's all right. It's fine. So a sub two transaction. I have a house. It's got a 2.8% mortgage. I lose my job. I have no equity because I only put 3% down. Um, I got a job, but it's out of state. Now this I can't rent it, doesn't care, just the whole setup. Somebody comes to you and says, "Hey, you have an asset, i.e., 2.8% mortgage, right?" The note's the asset, not the house in this case. Very
Right.
different than '08. Let's be clear, not '08. But yeah, there's a lot of business about people doing sub two transactions, but then you got to worry about bankruptcies and payments and all this other stuff. So it's definitely not a game that I want to play. But if we saw wholesaling spike 2020 to 2022, transactions not included, you're absolutely right. Sub two, it'll absolutely reduce foreclosures if it works. I'm not my thing, not going there, but it will definitely find people that are late and go, "Hey, I have a way for you to fix it." But yeah, it'll be
I
interesting to
think it
see.
already has. I
Yeah,
really do
probably.
think it already has,
Yeah,
because I think people got really crafty during COVID, and it would explain why. I mean, one of the most confusing things to me right now is why we have a 9% delinquency at FHA. It's like with all
yeah,
these
you were telling me
programs,
that.
how
Yeah,
could
yeah,
that
yeah, yeah.
be?
Yep.
And then, but I think that some of these, I mean, I've talked to a bunch of them, and I've been kind of blown away how active they've been. And I think they went in and they probably did a lot of saving, because what a lot of people expected is we would see a deed in lieu or we would
Hmm.
see,
Yeah.
people
Jingle
sell their
mail.
home
Yep. Hmm.
or
Yep.
well, or just sell their home when they were in
Yeah.
distress, like, as a way out of forbearance,
Yep.
and that was never as much as people thought.
No,
And so
less
I
than
wonder.
1%. Yeah, less
Right,
than
and so
1%.
I
Yeah.
think that this is how some of that was actually saved. I mean,
Yeah,
but this is
I
we
agree.
don't know yet. It's still the
Uh,
fog of war. We'll
yeah.
figure it
So
out,
there
but go
is
ahead.
no question. There is no question that sub two, AKA creative financing, is removing stress from the system. Now,
Yeah.
does that just delay stress and it blows up down the line? Don't know. But I do think it's fair to say it is delayed stress. But let's also go back to how I opened. I've studied the real estate market and the economy all the way back to 1970.
Mhm.
In 1981, 82, 83, 84, creative financing, Robert G. Allen, Carlton Sheets, they were doing a version of sub two. Very different because back then the mortgages could be assumed. It was a checkbox, it was an option. Um, but we have been here before. So I would ask people that are looking at today going, we're not seeing the stress or the end product. I would go back to the 80s because again, we saw rates spike, we saw transactions crash, we saw creative financing. I actually bought a book, Robert G. Allen first edition from 1981, and I'm going through it right now because I wanted to read what they did. I don't want to read the revision from 1990. I want to read the revision
Right,
from 1981. Right? What the heck was really
right,
happening? And it does
right.
seem like loan. It was called loan assumptions. It wasn't called sub two. Loan assumptions were a big deal in 81, 82, and 83. So
Mhm.
it does
Mhm.
work, right? If the loan is the asset, and if you can hold that asset until housing works itself out in a decade, you're going to be okay. It's a 30-year fixed rate loan. It's below inflation, right? 2.7, 2.8 below inflation. It's like free money. But you got to be able to hold long term. So
Yeah.
it's weird. It's
Yeah,
weird.
and that's the key, right? You can't be
Oh, you can't be in
you
and out.
cannot be under pressure to offload it. Yeah. Okay, well, Michael, this has been so much fun, I've really enjoyed it. What are your last words after this conversation?
I guess I go back to my theme is it is affordability sucks today. It is hard. It's not the worst ever. 1981 was the worst ever, but it's hard. It's terrible. I don't see a quick resolution, as we talked about earlier. But that said, what really bugs me about the true crash bros is they act like it's not possible to get a great deal. That just annoys me to no end. If you do the work, if you're focused, if you keep at it, great deals happen all the time. I just hate that mentality that it's impossible. It might be impossible for you because you don't know, but it's not. And that really bugs me. So I still believe that's true.
And I would agree with you. I mean, you just gave a good story about that builder, and I think if you do the homework and you have your facts and you're looking up things like delinquency or tax liens or things like that, you're gonna be able to find a good deal because you're gonna
Mhm.
have all the facts on your side to go into
Exactly.
that negotiation. So I think you and I agree on that for sure.
Yeah, it's
But
awesome.
this has been a lot of fun, Michael.
Melody, I thank you for doing this. This was a great honor and a privilege to have you on the channel, asking me hard questions. The audience always wanted this to happen. So thank you for saying yes and have a wonderful week.
Have a wonderful week. Thank you so much.
Bye.